I'm Iain Pyle and I'm the portfolio manager of Shires Income Trust. The objective of the trust is to deliver a high level of income and retain the potential for long-term capital growth. We do that by investing primarily in UK equities, but we have around 20% of the portfolio in preference shares, which deliver a defensive high yield. We also have 10% overseas equity exposure to provide diversification. And the result is a portfolio that has a high yield. The shares yield about 6.5% today, but it's defensive and it can still hold enough growth exposure to deliver long-term capital growth as well. So the aim of delivering that high income yield for clients is really a determinant of the style of the portfolio. So that means we skew towards higher yielding stocks and it gives us a bit more exposure to some value sectors in the market. But we try and be very agnostic in how we invest because we want both income growth, and capital growth out of the portfolio. And we will look across market sectors and across the size of companies, the range of companies out there to deliver that. We try and be very flexible in the headline yield of the portfolios we invest in, and we try and really look for growth over the longer term as well. So very much a style agnostic portfolio where we focus much more on the company fundamentals, but that bias towards high income and high defensive quality in the portfolio really drives the style. So the themes that investors really gain exposure to here are good quality companies from the UK. So we're very focused on getting companies that will be defensive, that will deliver income and income growth over the long term. And that gives you a really good defensive portfolio overall. I think at the moment, the other theme that we're really taking exposure to is an overweight position in UK small and mid-cap equities, because there's a lot of great companies in this part of the market. It's also a great source of income growth over the long term. But at the moment, it trades at a record valuation discount to world equities compared to history. And I think as we move through this year, we start to see interest rates come back and we start to see some political certainty in the UK. That's a really good environment for UK small and mid caps to perform well. So a strong theme that we're taking exposure to. Shires is differentiated from other UK equity income funds in two main ways. I think the first one is the preference share portfolio. Having 20% of our assets in fixed income instruments, which have a very high yield, which is very defensive, means firstly, we have a high degree of safety on the income for end clients, which is very useful. But secondly, it also means we're not chasing high dividend yield stocks in the equity portfolio. So we're able to hold things which are more growthy, things which are more focused on dividend growth. And that gives a more balanced performance between high yield and capital growth over the long term. The second differentiating factor, I think, is a real exposure to small and mid-cap companies in the UK. We do hold plenty of large cap names as well, and we tend to be quite size agnostic, but we are clearly overweight small and mid-cap positions, and that's an area we believe gives us a real differentiation, both in finding companies that are underappreciated by the market, but also getting exposure to growth and dividend growth that you might not get out of the large cap part of the market. I've been a portfolio manager at Aberdeen since 2015, and during that time I've run a range of funds from UK core, pan-European equities, and more recently UK income mandates. I've been managing Shires Income since 2018, and before I was at Aberdeen as a portfolio manager, I was a sell-side equity analyst covering the energy sector for 6 and 7 years. And before that, I was a consultant. I'm a chartered accountant and a CFA charter holder.